the Fed break the stock market last week? That's the question that we are asking here on Macro Money. I'm Ilya Spivak, head of global macro here at Tasty Live. And it's an interesting question to ask because, of course, last week was a bit bifurcated, a tale of two stories here with the Fed in the middle. Markets gapped higher and went up into the Fed meeting, stalled on the day of, and have come down since. Now, things idled Friday. They continue to idle today. Markets still not finding meaningful follow through, but whatever happened on Fed Day, the subsequent day was a sell-off, and we've been basically stuck since. So the question in front of us here is, did the Fed actually tip some sort of scale here, sentiment-wise, or is this just a pause amid the ongoing government shutdown where we don't have data, the earnings calendar has slowed, and so we're searching for a trigger and perhaps not yet finding one? Let's begin in trying to unspool all of this with a look at last week's performance. We can see a quiet advance here for the S&P. It ultimately ends up rising 0.7% on net for the week. But what this obfuscates to some extent, as we've just said, is since the day of the Fed, our net performance here is leaving, let us say, something to be desired. So if we look at where the markets closed on Fed Day, which is the 29th, we are at this point down just about 0.6% on the S&P. As of Friday, we were down as much as 1.14%, and going into the Fed, by the close of the day prior to the Fed, we were up about 1.45%. So interesting sort of setup. And of course, the day immediately after the Fed meeting, the S&P jumps intraday to a new record high, but then ultimately ends up finishing the day down almost a full percentage point, 0.97%, which actually ends up being the biggest decline since that big October sell-off where the index fell nearly 3%, or 2.7 to be exact. So we have here an interesting kind of thing where the market is not really running away to the downside, but not really finding conviction to the upside either. Whatever the Fed did, there was a one-day sell-off, and since then, crickets. Buyers not really using this as an opportunity to step back in. Sellers not really pushing the envelope. NASDAQ performing a little bit better, 1.9%, still a slower week than the prior one, and a similar story where a series of inside days is what we're looking at here, but a little bit better on the whole, if only because tech earnings last week were, for the most part, solid. Meta, of course, had a sizable miss. Amazon did exceedingly well out of its numbers. And we have, of course, also a surge from Google, and Microsoft ultimately had decent numbers, fell a little bit, but ultimately didn't go very far. And, of course, Apple had a kind of a nothing of a week where it was already out there out of reporting from the private sector and survey data and things that iPhone 17 sales were going relatively well. And so we didn't have the kind of surprise when the earnings essentially showed that. And so we had a kind of neutral response there, even though the numbers on the earnings front were reasonably solid. So kind of a week of not particularly strong conviction last week, but certainly a marker around that Fed meeting where, of course, Fed Chair Jerome Powell pointedly came out and said, just in case you guys are confused, we are not looking at December as a foregone conclusion for a rate cut. Far from it. And really made a point of pounding the podium and delivering that message. And of course, Fed funds futures had December well over 90% chance when this meeting occurred. We can see here the way that things have evolved since then. We're looking at now the probability that we get this hike or this cut rather in December just north of about 60%, 67.5%. That's down from 94.4 a week before. If we look at the likelihood that we stand still, 32.5% up from 5.5 the week before. So we're looking at a situation here where the calculus has meaningfully changed for markets. And that seemed to have been an important inflection point for sentiment, whereby since that adjustment was activated, the markets haven't been able to find their stride. Looking at the rest of the asset mix here, we can clearly see yields up around that very same idea. 10-year up 2%, 2-year up 2.8%. So it is indeed the near-term story that gave us a situation here where the adjustment was most significant. Markets really focusing on what the Fed is likely to do nearer term versus the other way around. The longer end holding a little bit steadier. Crude oil moderating a little bit after that huge jump of 7.6%, down almost a percent. That, of course, around the idea that surge around the idea that the U.S. has put Lukoil and Rosneft, two big Russian oil producers, on its entities list, which basically says that if you do business with them, you're not doing business with the U.S. And that seemed to be a sort of shot across the bow for India and China to stop buying Russian crude on the gray market. And since then, things have kind of eased off. Ostensibly, the story hasn't picked up more legs, and with the Trump and Xi conversation relatively friendly or so last week, at least relative to what it could have been, a little bit cooler on crude oil, though not much. Gold, a second week of losses, down 3.4%. The dollar strong across the board. Euro down 0.9%. So is the yen. Bitcoin ultimately resolving down. So the risk sentiment gauge that is Bitcoin, which is usually sort of risk sentiment on steroids. If stocks go up, it goes up more. If stocks go down, it goes down more. Here, there's obviously a little bit of a divergence. Stocks ultimately hold up better. Bitcoin softer. Maybe that reflects the stronger dollar, but there does seem to be more here. And of course, that raises the question as to whether Bitcoin is signaling something about broader risk-taking that stock markets have yet to catch up to. As far as the data flow this week, we got the beginnings of what is the tiny bit of fundamental data that we're going to get, macro data that we're going to get this week. Obviously, the ongoing U.S. government shutdown has mostly taken everything offline. We still don't know if we're going to get a U.S. jobs report at the end of this week. Maybe we will, maybe we won't. But the Institute of Supply Management gives us a little bit of a glance at the economy, and it isn't a happy glance. Manufacturing, it looks like, was again in contraction mode. That much was to be expected. As ever, these numbers are centered around 50, where that's neutral. Below 50 is contraction, above 50 is growth. The further you go below 50, the faster the contraction. The further you go above 50, the faster the growth. Manufacturing sector, of course, the smaller of the bunch, services a much bigger contribution to the overall economy. We'll get those numbers on Wednesday. The manufacturing side coming in at 48.7. Expectation was 49.5. So we get the contraction, but it's a faster contraction than anticipated. Looking at the internals here, we get new orders shrinking, so sub 50, but we can see here at a slightly slower rate than the prior month. We can see employment shrinking, but at a slightly slower rate. So ostensibly not great, but not as bad as it was the prior month. The price side of the equation, we can see, continues to moderate. We've come a long way in cooling the pace of price growth in manufacturing. It's still relatively elevated compared to history, going back here to sort of the immediate post-pandemic period. And we can see that on the manufacturing side, inflation was much more curtailed, and between this undershooting and this overshooting, sort of averaging near standstill. Obviously, there was this huge surge. One wonders what it could have possibly been at the beginning of 2025. Oh, wait, that's right. That would be the tariff rollout. Perhaps one Stephen Mirren might look at that as he says that tariffs don't impact inflation, in particular on the goods side. One would surmise, looking at this, that they in fact very much do. But since then, we've seen things settle and things have calmed down. And so perhaps we've reached a level of some kind of digestion of what these tariffs are going to mean, at least here and at least from a sentiment perspective. Though, of course, since there hasn't really been this much relief on the tariffs as to completely unwind all of this, one does wonder if maybe this portends expectations for slowing economic activity. We'll see what that ends up looking like. We have, in the wake of last week's Fed shocker, a significant readjustment and a significant reshuffling of policy expectations. As we just saw, we have this much diminished probability that we're going to get another cut in December, which, of course, in any case, was something of a smoke and mirrors forecast. We can see for the Fed here in September, they do have 3 cuts in their forecast, but we also see, and by the way, this is 4.4 is the starting line here. So from 4.4 to 3.6, that's 0.8 or 3 cuts, 0.75 rounded up to the nearest 10th decimal. But we can see that the way we got there was this big outlier of a dot on officials forecasting. We can see the majority of officials very much skewed toward 1 or 2 cuts. Here's a third cut here being essentially forced into the median by this vast departure from the consensus here. And we don't know if that's Stephen Mirren, but I think we kind of do, at least with relative confidence. And we can see here that looking at the way things have evolved, the markets are only priced at this point for 6 basis points through the rest of the year. So we're looking at maybe a very slight chance that we're going to get this cut. Now, obviously, once we get into the actual dates, you can see this is December 10th. Once we get into the dates, the chances go up. But needless to say, this has been significantly diminished. We're still looking at 63 basis points for next year, which is, of course, well in excess of what the Fed is saying. They're still saying, again, just 1 cut here from 3.6 to 3.4. That, of course, is a single 25 basis point cut, again, rounded. So we're looking at still an important disconnect between the Fed and markets. But the larger story here is, of course, that the view for this year, at least for the last meeting of the year, has been significantly adjusted. Moreover, the view for next year has eased a bit, even though it's still expansive relative to the baseline. And we can see what the results have been. So as you've adjusted to a less dovish setting, we can see stocks have stopped going up. This is that range where we're now stuck in. And the dollar continues to push higher as we take some of this dovish signaling off the table. It continues to advance, having essentially retested the bottoms from July and then launched higher as of the beginning of October. For the rest of the week, we mentioned this Wednesday ISM services report. That'll be important to watch here. We can see the expectation is that we're going to see a slight pickup after a standstill in September, a slight pickup, but only just so in October, up to 50.7. If we take a look at what that means here, 48 and 50.7 probably averages to something approaching 50 for a sort of composite view. Obviously, services is a bigger component, as we said, of the economy than is manufacturing. So skew it in this direction, and this weak number probably discounts this down to something like a 50. And we'll see, of course, how that ultimately plays. But arguably the biggest question here is what the price component is going to say. Since, of course, this is the biggest part of the economy, the price component here is oftentimes telling of broader trends and tends to run ahead of the baseline PCE and CPI measures of inflation by about 2 to 3 months. And when we've got this lagged here, this is CPI lagged 2 months, this is PCE lagged 2 months, we can see it lines up pretty well with this service sector ISM, which would suggest that there is some sort of an inflationary pickup in the works in the months ahead, if this is going to hold. And if that's the case, well, then the Fed might well be justified in downplaying how much easing it is going to do from here. And to the extent that this has left the markets without upside thrust, if we continue to see this shift into a more inflationary setting, then perhaps that sort of de-risking around the idea that more Fed stimulus is coming, if we keep diluting that, that could very well give us a further anti-risk adjustment. In other words, this lower and this still higher. And aside from that, a couple policy announcements. RBA is expected to keep rates unchanged. They had a slightly chipper inflation report in the most recent set of numbers, so they're not expected to do anything. Bank of England likewise seen holding rates unchanged. Their inflation has stabilized a little bit, but at a relatively higher level. And so no big changes expected there. The voting tally on the MPC expected to be 6 to 9 in favor of standstill, 3 to 9 in favor of a cut. We'll see if that reshuffling of votes actually holds up, and if we get perhaps some sort of a sense as to whether the Bank of England is thinking about changing gears. But for now, with inflation basically holding steady for the past 3 months, there doesn't seem to be a strong impetus there for one thing or another. We will have Chinese numbers on trade on Friday. See if that moves the needle on anything trade war related. And then in the absence of the jobs report, which may or may not appear depending on how this government shutdown goes, we've got the University of Michigan Consumer Confidence Survey, another kind of private sector stand-in for official data. The expectation is that we're going to come in a little bit on the headline sentiment reading from 53.6 to 53.2. If we take a look at what that looks like here, that would be a further deterioration in sentiment, which has been, as we can see here, deteriorating despite this cool-off in inflation expectations. This is perhaps the most interesting part of the current story. We can see that coming out of COVID, consumer confidence was very clearly coming down as one-year inflation expectations within that same University of Michigan survey were coming up. So prices going up, inflation accelerating, consumers don't like it. Rocket science, that is not. Once the Fed really starts to get going on rate hikes in early 2022, we can see inflation expectations start to come down and have a nice long arc from 5.4 to 2.6, basically within a hair of the Fed target as we get into the beginning of 2025. But then, of course, the tariffs. And so as this inflation expectation number comes in, sentiment improves. We can see we start to hit multi-year highs here going into the middle of last year. And then tariffs. Consumer confidence is yanked sharply lower as we jump a whole 4% on the one-year inflation expectation from 2.6 to 6.6. Now, we've given away about half of that move. We're at 4.6 now. But note that despite this kind of wiggle higher as things cool off in the wake of the backpedaling on Liberation Day after early April and so forth at the White House, consumer confidence has hardly improved. It's had this little wiggle higher and it is now right back down to where it was as the tariff scare was heating up. And so this raises an important question here. As a matter of fact, we can see the assessment of current conditions is now worse than it was then. Expectations are still a little bit better. Overall, just about unchanged. And that, of course, raises a very important question for the economy because it is 68% household consumption. And if this part gives way, well, then there's not really much of a leg to stand on. Nevertheless, for now, looking at the Atlanta Fed GDP now model here, it's not so much that we're, as ever, looking to make sense of this and use it to forecast third quarter GDP. It is entirely too early for all that. But we do see that essentially since the beginning of August, the tone for the economic data going into this model has been improving. So much so that, in fact, even the blue chip consensus here has been revised higher. So we are looking for the economy apparently to be accelerating. And so we'll see if perhaps this consumer confidence data goes that way. But then the real question is, well, if it is accelerating, then the Fed has less room to cut. And the markets don't like that. And if it's not accelerating, then the Fed is still perhaps reluctant to cut and wouldn't know otherwise because there isn't economic data in aggregate and en masse to show as much. But what we end up with then is a situation where either we have a worrying downturn that the market isn't ready for, or we have a situation where the Fed is not going to give markets everything they want and a disappointment around that idea. So however one were to go about slicing this, we end up with something that ends up being, or at least looking like, a potential risk for sentiment. With that in mind, I am looking at my exposure here, and there isn't a whole lot that I have to change. I'm still long the dollar, short the Aussie, short the pound. I got a little bit bigger, as a matter of fact, in my short euro position. You can see all of these are selling 2 contracts. This is now selling 3 because the euro seems to have continued to decline. Still short gold, both through a short call vertical and through outright futures. Still short Bitcoin. That continues to edge down through an IBIT, that's the ETF put vertical along that. A little bit short risk through SPY put verticals. Still long at the long end of the bond market through TLT call verticals. That one's been going the wrong way. We'll see if it finds bottom here or not. I'm starting to think about where the ripcord is on this. Perhaps not yet, but maybe soon. And still short a little bit of crude oil as it comes down and starts to moderate after last week, or the prior weeks, the week before last, after that big surge and all of those shenanigans. And that is Macro Money for today. As ever, we are here Monday through Thursday, right after overtime, a show I usually co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I am also writing for the News and Insights portion of tastylive.com, commenting at Ilya Spivak on former Twitter and on Blue Sky. If you're watching this on YouTube, like and subscribe. Macro Money is back tomorrow. Happy trading.